Okay, let's jump right into this explainer and figure out whether True North Commercial REIT is the ultimate deep value hidden gem, or if it's just a ticking debt bomb waiting to go off. We're looking at a small cap Canadian real estate investment trust here, trading under the ticker TNT-UN.TO, and man, it is flashing some wildly contradictory signals right now. If you've been hunting the market for yield, there's a good chance this one has already crossed your radar. But as we're about to see, the surface level numbers, they really only tell a fraction of the story.
Before we really get into the weeds, you just have to consider this staggering number. A 51.6% discount to net asset value, sitting right alongside an 8.25% dividend yield. Just let that sink in for a second. You are essentially looking at an asset trading for half of what its underlying properties are theoretically worth, all while it's paying you out over 8% just to hold it. Sounds like an absolute dream scenario, right? But listen, the market rarely leaves a 50% discount sitting on the table without a very, very good reason.
So, here is our analytical funnel for today. We'll start with a business summary, calculate the intrinsic value, run our deep dive analysis, weigh the SWOT and scenarios, map out exact buy and sell targets, and then wrap up with a final verdict. Let's kick things off with Section 1, Business Summary.
Let's start with the foundation and look at what True North actually does to generate its cash. And honestly, what's truly fascinating and a bit paradoxical is their income statement. On the top line, True North is pulling in 130 million Canadian dollars in annual revenue, which is a highly impressive 27.3% year-over-year growth. And at the property level, they are operating beautifully, boasting a 59.2% operating margin. That tells us their buildings are generating very healthy, consistent income. But wait, here's the catch. Despite that fantastic top-line performance, the REIT is posting severe net losses of $32.57 million. This massive disconnect between strong property margins and total net losses is a classic symptom of a stressed REIT, and it's driven heavily by non-operating factors, namely some seriously heavy interest expenses on their debt.
Moving right along to Section 2, Intrinsic Value.
Let's check out the valuation metrics to see just how incredibly cheap this stock really is relative to its actual cash generation. The discounts here are substantial, with the share price sitting right around $8.40 and a reported book value way up at $26.68. The gap is huge. Now, even if we play it safe and apply a conservative 35% haircut to that net asset value just to account for their high leverage and asset risk, we still arrive at an ANV of $17.34. That is literally more than double the current trading price. But arguably the most surprising metric of all is their estimated adjusted funds from operations payout ratio. Essentially, this is the REIT's true cash flow, and it sits at an unusually safe-looking 21.6%. This tells us that, mathematically anyway, that juicy 8.25% dividend is exceptionally well covered by their actual operating cash.
Now for Section 3, Deep Dive Analysis.
When we check off every single category in our 12-point deep dive to find out where the true risks are hiding, we find a pretty stark contrast. On one hand, you have excellent profitability and an operating cash flow of $71 million. That right there is the true engine powering the dividend we just talked about. But acting as a massive anchor dragging the whole ship down is a terrifying 196% debt-to-equity ratio. We're talking over $735 million in debt. To make things even tighter, their current ratio sits at a dangerously low 0.14, meaning their liquidity is severely constrained. They are heavily reliant on external capital and their ability to successfully refinance this mountain of debt. Zooming out a bit to their operations, True North basically runs a simple landlord business model. The problem? They completely lack a strong competitive moat. With a tiny market cap of just over $117 million, they just don't have the scale to negotiate highly favorable financing terms or to compete for top-tier prime assets against the giant diversified REITs out there. It's not all bad news on the management front, though. Insider ownership sits at a totally respectable 12.14%, so there is some genuine alignment with shareholders here, even if their historical capital allocation, specifically the decision to rack up all that leverage, is highly questionable. So the whole mispricing thesis here, it's your classic high-risk, high-reward scenario. That massive margin of safety we identified earlier exists entirely because of market terror over two main things: their bloated debt profile and their cyclical exposure to commercial office space. Let's be real, the long-term outlook for office buildings remains incredibly uncertain right now. If True North can maintain its tenant occupancy and successfully manage those heavy debt obligations, this thing could stabilize and deliver unbelievable returns. But if they fail, that margin of safety could evaporate in a heartbeat. And that brings us to the immediate red flags you absolutely must accept if you're considering a position. You are buying into extreme leverage, consistent corporate-level net losses, the inherent cyclical risk of the commercial office market, and the very real looming threat of commercial real estate write-downs. You have to go into this eyes wide open, fully aware that this is definitely not a sleep well at night defensive play. All right, Section 4, SWOT and Scenarios. Let's synthesize all this raw data into a weighted SWOT analysis. The total score comes out to a modest 5.8 out of 10. But the interesting part is how we get there. The sheer magnitude of the discount to net asset value carries the heaviest weight at 30%, which heavily anchors the positive side of the score. This deep discount, combined with those strong cash flows, completely overpowers the severe penalties we had to assign to their staggering leverage and weak overall profitability. It's basically a tug of war between amazing cash-generating properties and a highly indebted balance sheet. So, what does this all mean for the future of the stock? Let's break out the scenario analysis. If refinancing stress hits them hard and occupancy declines, our bear case drops the price down to the $5 or $6 range. Now, if operations remain stable and they manage to gradually pay down that debt, our base case sees the price hovering between $8 and $11. But if we see successful deleveraging and market sentiment actually improves around office real estate, the bull case could rocket the share price up anywhere between $14 and $18. The upside potential here is undeniably massive. Let's get into Section 5, Buy and Sell Targets.
This is where we translate all this deep analytical theory into an actual action plan. Let's establish our investment goal, aiming for an average 9% annual return over a 16-year holding period. If that's your target, the math dictates your absolute maximum buy price is $7 per share. If you were to buy in at today's price of around $8.40, your projected return over that long timeline drops closer to the 7 or 8% mark. But what if you aren't willing to wait 16 years? If you compress that timeline and want to hit that same 9% return over just a 5-year horizon, you could safely buy in at up to $8. Notice how the required buy price actually drops as the time horizon extends? That specifically accounts for the prolonged compounding risk associated with holding such highly leveraged assets over a long period of time.
Of course, a good entry is totally useless without a disciplined exit strategy. The valuation math tells us you should be trimming your position once the share price crosses $12, locking in some of those gains as the risk profile starts to shift. And if that elusive bull case actually materializes, you should be running for the exits completely once the price pushes above $16, because at that premium, the margin of safety will have essentially vanished.
Finally, Section 6, Final Verdict. Weighing everything together for our final scores, we have a risk score of 6.8 out of 10, fighting against an opportunity score of 7.2 out of 10. This perfectly defines True North Commercial REIT as a quintessential turnaround play. The legendary investor Peter Lynch would absolutely classify this as a classic turnaround situation, finding deep value hiding right beneath the market's panic. On the flip side, someone like Charlie Munger, who preferred wonderful businesses at fair prices, would likely take one single look at that 19.6% debt ratio and avoid it entirely.
So, the final verdict from our analysis. This is a speculative buy. It offers significant potential returns, supported by incredibly strong property-level cash flow, but it demands an absolute iron stomach for volatility, and you have to accept the genuine possibility of downside if their debt refinancing hits a brick wall. Basically, you are getting paid a hefty premium to take on that balance sheet risk. And that wraps up our deep dive into the fascinating, high-stakes numbers behind True North Commercial REIT. We've laid out the data, the targets, and the risks. So tell me, what stock do you want us to put through the analytical funnel next? Let me know down in the comments below, and I'll catch you in the next explainer.